And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Well, it's Friday afternoon, and of course that means it's time to talk finance with Luke Smith from Envision Financial. Good afternoon.
Good afternoon.
Well, here we are again, another beautiful Canberra day, and we're expecting showers over the weekend, but look, we can always cast a little bit of financial sunshine on everybody with our discussions every Friday afternoon.
Just a little something to get into the weekend.
Absolutely. Today we're going to talk about exchange-traded funds, or just ETFs for short, and why they could be right for your portfolio. And I'm pretty sure there's a lot of good reasons, aren't there?
Yeah, look, this is sort of quite prevalent, and I think people need to just understand the acronym. You know, this is a very acronym-driven industry, but an ETF or an exchange-traded fund is simply an investment that replicates a particular index. And people go, well, what's an index? And I often say to people, well, when you're watching the news at night and just before the weather, they say the ASX 200 was up 10 points today. The S&P 500 index was up 15 points today. An index is just a part of a market. It's a selection of assets in a particular group that identifies the exposure to a global or domestic area. ASX 200, ASX 100. You have the ASX top 20, top 50. You have the S&P 500, and so on and so on. And you can get an ETF now in just about anything. So an ETF just replicates a particular part of a market, and you might choose to say, well, I really like technology. I might buy the NASDAQ index, and you can buy an ETF that replicates that index. I really like the S&P 500 in America, so I can buy an ETF that replicates exactly that index. So an ETF is just an investment tool that replicates a part of a market that you can choose to be exposed to. Now, some of the advantages of an ETF are that they are generally either passive, they replicate a group of stocks, or more active, where the investment provider will be more transaction-based and trying to generate some outperformance by moving in and out of investment opportunities in a similar way to a traditional managed fund. They are very cost-effective in relation to their expense to use. So when we buy an investment, we incur what's called an ICR, and that acronym stands for Internal Cost Ratio. It's a very fancy way of saying, what does the thing I'm using cost me to use? Now, an ETF is generally very, very cheap. We can buy the S&P 500 index in America for 0.04%. You could buy the ASX 200 biggest companies in an ETF for anything from 0.04 to 0.07 to 0.15. Now, for context, if you were to go to a traditional managed fund, the cost to buy into that fund and use it could be between 0.75 and 1.5%, depending on what they do and how they operate. So as you can see there, ETFs are a very, very cost-effective way to get good broad diversification, to be able to target specific areas of a market. You also have a lot of transparency in relation to what the ETF holds. So you can see exactly where your money's invested, you can see exactly what it's invested in, and the allocations and weightings from a risk standpoint. And a lot of people appreciate that, because you may not want to sit at home every day and look at the screen and say, well, I'll buy Macquarie, sell Macquarie, buy NAB, sell NAB, buy this, sell that. If that's for you, great. If that's how you want to spend your retirement, you should probably have more hobbies. But an ETF is a wonderful way to say, I've got a broad exposure to an area of a market that I know I'm comfortable holding, and you can buy an ETF in just about any field. You can buy Australian, international, infrastructure, property, fixed interest. So you can have a very broad spread of where you invest, and then the how is provided by the relevant provider. And there are many providers that have an ETF in just about anything. So you might say, I really like gold. There'll be a gold ETF. I really like oil. I can buy an oil ETF. I can buy high growth. I can buy tech. I can buy semiconductors. There will be an ETF in just about anything if you look hard enough, and you can use those to then build a diversified portfolio, managing a level of risk that you're comfortable with the vehicles available and at your disposal.
I know that SpaceX is running its initial public offering around about this weekend, and there are other big tech companies doing the similar sort of thing at the moment. Yeah. It won't be long before we've got an ETF for space companies, will it?
Well, I think, and again, this is a way to then sort of indirectly pick up that sort of exposure, because once that lists, because of its size, it'll probably end up in, well, what will definitely be in the top 100.
Yeah.
So like a NASDAQ ETF in that sector will have to maintain it. And that's the thing with a lot of these ETFs. As the values of companies move in and out of different indexes, they will have to buy that underlying stock because they need to replicate the holdings.
Yes.
So that would be a way to acquire a non-direct exposure to something like that, where you're unable to get the firm stock pre-allocation to the float, which will be hard to get hold of. So it's important that people use these and don't think that they're, we're not saying at all that they're risk-free. You're maintaining the same level of risk that you would depending on the area that you've invested in, but you will benefit from income dividends. You'll benefit from franking credits. So an ETF gives all of the distributable benefits of the underlying assets. So if you bought one that replicated the ASX 200, you will get regular dividends from that collection of companies. Where the companies in that index provide franking credits, you paid out those franking credits and you receive those entitlements in a similar way that you would if you'd bought the CBA share directly. You still have all of those entitlements and benefits where you use an ETF. So there's nothing in relation to loss or anything that you miss out on, but a wonderful way to also then get into a market with a smaller entry value. So what I mean by that is you might want to start your investing journey and go, well, I'm going to buy $500 of Commonwealth Bank shares. From a risk perspective, you've got everything tied to that one investment. If you went and bought an ETF and you had the ASX 200 with your $500 of investment, you've got a much broader exposure to both good and bad movements, and you're not heavily reliant on one individual company. So they're a wonderful diversifier and a wonderful vehicle to start an investment journey, because a number of providers have platforms now where you can open an account with $200, $100, $500, and then pick from a really broad range of ETF options and start your investment journey with a little bit of money and then add to it over time, as opposed to the broad assumption of, I need 50 grand to start, when you actually really don't.
That is one of the key benefits of an ETF, isn't it? It provides that opportunity for smaller investors to get into a genuinely diversified portfolio. Even if you pick one particular sector, you still get a broad spread of interests within that portfolio.
Exactly. And if you think about it like your super fund, a lot of people just end up in the balanced option of their super fund because they're not that interested and it's sort of a middle of the road position. Well, you could do exactly the same thing outside of superannuation for a portfolio in your own name. You could go to a Beta Shares, you could go to a Vanguard, you could go to a BlackRock, and you could say, right, do you have, for example, a growth ETF? And they'll say, yep, we have this one here. And that has 70% in growth assets, which will be Australian shares, international property and infrastructure. And we have 30% in cash, fixed interest and defensive assets. And you could just buy into that in exactly the same way that you buy into the balance fund in your industry account, where you're not overly aware or fussed about what they're invested in, but you know you have a suitable mix of assets that over time will give you growth and income. And that would be a great way for you to start something outside of super and complement your existing investments that you can't get till you're 60, but you can invest outside and have full access and liquidity. I think it's also a wonderful idea for parents where, okay, we've had some kids, great. And rather than just leave all the money that Nanny and Poppy gives you in a bank account, open up something like that because you want to benefit from compounding over time and the reinvestment of income. So an ETF will also allow you to then reinvest the dividend that's paid from the underlying investment into more units in that ETF. So a great way to benefit from compound interest, a great way to set up the next generation by accident, and then have them engaged and understand the investment journey as they get older, where, okay, we've got a little bit of a job, we've got a little bit of part-time money, okay, let's put some into that, and let's get them fully invested, bar the pun, in the process of learning about finance and learning about savings and learning about what they do, rather than getting to 35, walking in my office and saying, oh, now I need to be a big person.
Another key benefit of exchange-traded funds that we haven't really mentioned in any detail so far is right there in the name. These are exchange-traded, which means anybody can buy them on the stock exchange just like a share. It's
Correct.
actually a really easy process, and that provides for the liquidity that you were just talking about.
Exactly right. And as you say, it's all in the name. We're replicating an exchange. It's traded, and we have an asset that has a collective combination of underlying holdings. So you can go on and say, I can buy shares in Commonwealth Bank. I could buy shares in STW. STW is the trading code for one of the ETFs that replicates the ASX 200. IVV, for example, is a trading code that replicates the S&P 500 in America. So depending on what you want to be exposed to, you first have to sit down and say, right, what am I trying to buy? And where am I trying to be exposed from an investment perspective? Once you've done that, you can then look around and say, okay, who can provide me with an ETF in the relevant area that you want to be exposed to? Now, two different ways that an ETF can be structured. One is on market cap, or the largest company in that index to the smallest company in the index. So you might say the ASX 200, number one. It has a huge amount of shares on offer in the market and has a large market capitalisation. So it's the biggest by size. Right down to number 200, which will be much smaller. So you can buy an ETF that replicates an index that way. You can also buy what's called an equal weight ETF, where they say, right, we're going to buy everything in the ASX 200, but we're not going to go from biggest to smallest. We're going to go at 1.5% each. So you can then start to combine ETFs to further diversify and mitigate risk by holding different underlying investment philosophies in an area that is appropriate for you as part of your broader asset allocation journey.
And while investing often sounds complicated and intricate and involved, ETFs have the benefit of actually making the process very simple.
Exactly right. And again, depending on the super fund that you're in, you may or may not be able to use them. So again, you need to go to your fund. You might say, well, that sounds quite interesting. I'd really like to buy something in that area. You can go to your superannuation fund and say, well, can I buy these? And this is why I often say, when I'm here on a Friday, a mini won't pull a horse float. I know a mini won't pull a horse float, and most people can picture that in their minds, but I'm actually saying that not all super funds are the same, just like not all cars are the same. So just because you're in a fund and you go, oh, these are great, I'm going to race out and get some. First, you need to go to your fund and say, hey, do you make this type of investment available? And you need to look at what's called the fund's approved product list, or APL. And that says, right, you can invest in this collection of assets and then go ahead and choose what you want. If you don't have that option in your fund, then you might want to look at another fund provider and potentially roll over some of your money to another fund that does allow you to buy these sorts of things, if that's the journey that you want to then go down and start making part of your portfolio.
Indeed, or simply buy them direct outside of your super.
Exactly right. Yep, exactly right. Can do that too.
Luke Smith from Envision Financial is with me in the studio today. We're talking about exchange-traded funds and why they could be right for your portfolio. Back with more in just a moment. Luke Smith from Envision Financial is with me today. We're talking about exchange-traded funds. What are they and why they could be right for you? We've covered a fair bit of territory today, Luke. So what are the key things people need to remember about exchange-traded funds?
Yeah, so first of all, a wonderful way to diversify an exposure to a part of a market. Okay, so they're not everything to everybody. They are just a product or an investment structure that allows you to replicate a particular part of a market. So you still need to think about, where am I going to invest and what level of risk am I going to take on? You then need to investigate, well, which product can I use to be able to buy into that area that I like? And there's an ETF now these days for just about anything. There are multiple large providers. There are ways to get into ETFs through the likes of a BetaShares or a Vanguard or a BlackRock or some of those. Also then look through your super fund. Are they available in the super fund that I use? They are listed, so you buy them like a share. So you pay brokerage when you acquire them. You pay brokerage when you sell them. You get dividends from them over the holding journey, depending on the sector that you've bought into. If you're in the Australian space and you're entitled to franking credits, they will pass those out as well. They are very, very cost effective when it comes to the ICR, which is the internal cost ratio, the cost to use the thing that is providing you with the exposure. Generally speaking, far, far cheaper than a traditional managed fund. You need to look and understand what is the investment philosophy and structure of the ETF. Are we buying things on market capitalisation, so biggest to smallest? Are we buying an equal weight exposure to a particular index where you might have 1 or 2% in 200 companies, which would be a great way to diversify away from the big end of town? Because what you often find with a lot of these ETFs is a huge proportion of a particular index is made up of a few companies. Now, if you look at the S&P 500, they make up 30-40% roughly of the S&P 500 is seven companies because they're massive. So you need to have a look and say, well, what are the exposures that I have? If you're going to hold 2 or 3 of these, make sure you're not buying 3 lots of the same thing, because 3 green apples is not diversified. So have a look under the hood, understand the tax complexity of what you're dealing with, buy it in the right structure. So you still need to come at investing with all of the normal questions. Why am I doing it? What's my level of risk? How am I going to be exposed? Where am I going to hold it? Is it inside super? Is it outside super? But the level of liquidity and transaction flexibility with an ETF is very, very high. They are generally very, very liquid. They are very, very cost effective. They are a great way for younger people to start. So rather than hanging your hat on Commonwealth Bank or Microsoft, you might say, right, I've got a growth ETF, just like your super fund. I've got 70% in growth, 30% in defensive, 85% in growth, 15% defensive, 50% growth, 50% defensive. So you can pick an ETF that suits your risk profile and your investment horizon. You could also then go out and buy some really sexy ones. And generally speaking, that'll come with its own level of sexiness and the problems associated with that. When they're good, they're good. When they're bad, they're bad. So we're not saying at any point here that these are risk-free. They are simply a vehicle that you can use to buy an exposure to a part of a market that you want to have long-term and short-term, and then get all of the benefits in relation to franking credits, income, reinvestment of dividends, compounding over time. And it's very, very appealing for the less informed to be able to start something with a smaller value. And generationally, for the mums and dads out there with kids, could open up one of these and put in $50 a month for your kids or your grandkids and watch that grow over time, because we all know that cash won't compound. But this would be a great way to set the kids up when they get to 20 or 25 and have a pool of money there that's really, really powerful.
So, Luke, where can people get more information?
Yeah, so office number 62604749. We've got envisionfinancial.com.au. On the internet, we've got the podcast, The Strategy Stack at Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube. And we've got Smart Money Strategy, your ultimate guide to financial planning, where we've got an entire chapter on ETFs and how they operate. It's all there. Luke, thanks very much. See you next week. Yep, we'll catch you again next week. I love it when we both try to talk at once. That's it. Indeed. Luke Smith from Envision Financial back with us again next Friday afternoon at the same time, right here on Radio 2CC.